So we have already seen first activity ratio or efficiency ratio, which was inventory turnover. Now let's look at the next one. Again, we will try to understand through an example. Let us say there are two companies, company A and company B. Total amount of credit sales made during the year by both the companies is 100, or let me just say 10 and 10. Okay, so let's say rupees in millions. So both the companies have made credit sales of 10 and 10 each. Average accounts receivable for company A is 2 and for company B is better. Accounts receivable are debtors and accounts receivable is an asset. So now tell me which company is better. Is company A better or B better? Is company A better or B better? How many of you feel A? How many of you feel B? Okay, the answer is A. The idea here is that on an average your accounts receivable, both of them have made same amount of credit sales, but A is a smart company because it has already recovered 8 out of those 10, right? So it is more smarter in terms of recovering that money, but B is relatively slower. It is taking more time to recover that amount. So the rule of thumb with money is the earlier you receive, smarter you are, and the later you pay, better it is, right? So when it is receiving money, you should receive early. When it is paying money, you should pay late. So what we would say here, we would calculate a ratio which is called accounts receivable turnover ratio. And how would that ratio be calculated? Accounts receivable turnover ratio would be calculated as credit sales divided by average accounts receivable, and in this case ratio would be 5, in this case ratio would be 2, and which is better? 5 is better, so we would say higher the better. You do not, the question she is asked that will company B get more interest? The answer is no. Accounts receivable do not pay you interest. Accounts receivable means you've sold goods on credit. Let's say both of us are business people, we sold goods of 10. Company A has already recovered 8, but company B has only recovered 5, and therefore company A is smarter because it is recovering money faster than its competitors. Are we good with this? Credit sale means you've made the sales but you've not received cash. And then using the same logic we can calculate a number of days in receivables. Number of days in receivable means on an average what was the credit period given, and in this case it would be calculated as 365 divided by 5, and this would be 365 divided by 2. So how much would this be? 73 days, and this would be 182.5 days. Okay, so we will do one more example to understand this concept better. Done writing up to now? Now let's do another example to understand this. Okay. So in case of company B, what's happening? Let us say this is day 0, this is day 365. What is the total amount of credit sales made this year by company B? 10. And what was the average amount of accounts receivable? 5. Okay. So on day 0 you start your business, you make credit sales of 5 today. You made credit sales of 5, and then you closed your shop. For half of the year you did not open the shop. On day 182.5 you opened your shop, you called up the person to whom you had made sales, you told him that you need to pay me now, right? So he came to you, he gave you cash of 5. The moment you received cash of 5, how much is your accounts receivable now? If you've received cash of 5, you made sales of 5, and then after 182.5 days he gave you cash. Now your accounts receivable is how much? 0. So now your AR has become 0. The moment it has become 0, you immediately made another credit sales of 5. So now your accounts receivable has become how much? 5. Then you closed your shop for half of the year, and by the end of the year again you opened your shop and you ask him to pay you that remaining 5. So total amount of sales made 10, but on an average at any point of time how much was the accounts receivable? 5. And therefore we would say that you have given your accounts receivable or debtors a average credit period of 182.5 days. Right? So if a new customer comes to you and he says, I want to purchase this good worth 5 lakh, what is the credit period? Your answer would be 182.5 days. Are we fine with this? And do you want this ratio to be higher or lower? You want this ratio to be higher. The number of days you want them to be lower, but turnover ratios you want them to be higher. Okay, so now see this carefully. Credit sales divided by average accounts receivable, you want this ratio to be higher, which means either the numerator would be higher or the denominator would be lower. Numerator will be higher if you make more amount of sales, which is not easily controllable. Right? How much amount of sales you make is a function of market. But average accounts receivable is something that you can yourself determine. Right? So if you give credit period of 3 months, and if you want to improve your ratio, what you can simply do is you can start giving credit period of 2 months. So what if now someone decides that I want to make this ratio as high as possible? Okay, so next time your customer comes to you, you tell him that now I will not give you credit of 3 months. Now I will give you credit of only 1 week. What will happen? The customer will go to someone else. Right? So in Pune, we have lot of automobile component suppliers. Right? Lot of companies, Walker Exhaust. So either making your silencers, shock ups, different component parts. Now the industry trend is, for example, let's say for a particular type of commodity, credit period is 3 months. And if your purchaser comes to you and you tell him that no, I will not give you credit of 3 months, now I will give you credit of only 1 week, his response would be that he would go to some other party and make the purchase. So higher the accounts receivable turnover ratio, better it is, but not at the cost of losing sales. Same logic with inventory. Higher inventory turnover, better it is, but not at the cost of losing sales. Are we fine with this? Then the next one, again there are two companies, company A, company B. Both of them have made credit purchase this year of 10 each. Okay, so both of them have made credit purchases worth 10 million. Average accounts payable for company A is 2 and company B is 5. Now tell me which one is better. B? Are you sure? How many of you feel B? A? Now the answer is B. The idea is when you're receiving payment you want to receive faster, but when you're making payment you want to make it slower. Right? So company B is smarter because it made the same amount of purchase, but it is still not made the full payment. It is made payment of only 5. Are we on agreement? So we will calculate accounts payable turnover ratio. And accounts payable turnover ratio would be calculated as credit purchase divided by average accounts payable. In this case ratio would be 5, in this case ratio would be 2. Now here we would say lower the better. Are we fine with this? And with the same applying the same formula, we can calculate number of days in accounts payable, and this would be 365 divided by 5, and this would be 365 divided by 2, 182.5. The interpretation is we got credit of 182.5 days, here we got credit of only 73 days, and the longer credit period you get, better it is for you. Do you want me to repeat this part again? See here, company B and A both made credit purchase of 10 each, but company A made payments too fast, and therefore now currently amount which is outstanding to be paid is only 2, whereas company B was slow in making payments, and therefore company B had to invest lesser amount into working capital. Imagine the formula of working capital: accounts cash plus inventory plus accounts receivable minus accounts payable, and larger the amount of accounts payable, better it is, because your working capital investment is lower, and company B is smart by delaying those payments of accounts payable. Are we fine with this? Now lower the better, but now again observe the formula carefully: credit purchase divided by average accounts payable. You can lower the formula by increasing the denominator. And how can you increase accounts payable? By simply not making payments, right? And if you simply stop making payments, then after some time you will lose your credit. Correct? So lower the better, but not at the cost of losing your credibility in the market. Is it fine? So let's reconcile all the formulas that we've learned so far. We are on activity or efficiency formulas. Okay, so we are trying to see with these formulas how smart the company is in management of working capital or fixed assets. Currently we are on working capital ratios. So we looked at 3 turnover ratios: inventory turnover, accounts receivable turnover, accounts payable turnover. Inventory turnover, so these are turnover ratios. Inventory turnover, what was the numerator? Cost of goods sold divided by average amount of inventory. Accounts receivable, what was the numerator? Credit sales divided by average amount of accounts receivable. And accounts payable, numerator was credit purchase divided by average amount of accounts payable. And then we calculated number of days, and number of days was straightforward: 365 divided by inventory turnover ratio, 365 divided by accounts receivable turnover ratio, and 365 divided by accounts payable turnover ratio. So you just divide 365 with turnover ratios and you would get number of days. Done writing? Now what is the interpretation? So for example, for a particular manufacturing company, if I tell you that inventory turnover ratio is 20 days, number of days in inventory is 20 days. What is the interpretation of this? What is the meaning of those 20 days? From the time inventory came into your factory till the time you have not sold it. So whatever you do with inventory, maybe you process, finish, package, you try to sell, from the time inventory came into your factory till the time you have not made sales, that average period is 20 days. If I tell you that number of days in accounts receivable is 30 days, then the interpretation of this 30 days, the day you make sales, after that it takes you 30 days to recover amount. Is it fine? And accounts payable number of days, so let's say if I tell you that these are 90 days, meaning of these 90 days is that the day you make purchase, you would make payment after 90 days. Is it fine? That's how we interpret these ratios. Okay. Now what we would be looking at is the practical application of these numbers. Okay, so be with me on this. Are you done writing this part? So let us say we are looking at a manufacturing company. Okay, some manufacturing, let's say food processing unit. Now on day 0, this is day 0, inventory came in, and it took that company 20 days to make sales, and the moment sales was made, that inventory was converted into accounts receivable, and it took them additional, so this period is 20 days, it took them additional 30 days to convert that accounts receivable into cash. So this is day 50. That means on day 0 your inventory came into the factory, and on day 50th you converted that inventory into cash. Can I say this 20 days is nothing but number of days in inventory? Is that same? So number of days in inventory, and this 30 days is nothing but number of days in accounts receivable, and the interpretation is this 50 days period is the time from which inventory gets converted into cash, and this is called as operating cycle of a business. Okay, this is the ratio for operating cycle, which is number of days in inventory plus number of days in accounts receivable, and the interpretation is the time a company takes to convert inventory into cash. So certain industries, for example, let us say food processing. Okay, I was working on financials of those few years back, those Balaji wafers. Have you seen them? Right, so that's a relatively faster inventory. Maybe within 7 days you can easily convert your inventory into sales, and within 3 days you will get money from distributors. So their entire operating cycle would be of 10 days. Right, time taken to convert inventory into cash. But think of real estate companies. Their cycle would be to purchase land, then to start construction activity. So real estate companies will have operating cycle of much more longer period, maybe 2 years, 3 years. Are we okay on this? So write down then. Operating cycle is nothing but a number of days in inventory plus number of days in accounts receivable. Now the next part you would enjoy the most. Now see what happens. The same company, day 0 inventory came in, on day 20th you converted that inventory into accounts receivable, on day 50th you converted that accounts receivable into cash. Okay, so from the time inventory came in till the time you got cash was 50 days. Can I say, and listen to me carefully here, can I say operating cycle is that time period within which you convert your cash into cash again? Is that correct? Operating cycle is that time period in which you convert your cash into cash again? Yes or no? The answer is no. Because do you see have we paid cash anywhere here? No. Cash, how much cash we've paid would depend on, and when we pay cash would depend on what is the amount of credit we have received. I mean, for how many days we have received the credit. So what if now our accounts payable have given us a credit period of 40 days. So on day 40 we would be required to pay cash. Do you agree? And on day 50 we will receive cash. So technically your cash, your own cash is locked in for how many days? Your own cash is locked in only for 10 days. This period is called net operating cycle or cash cycle. And how do we calculate that? So I'm writing the formula here. Cash cycle, which is also called as net operating cycle. Same thing. The formula would be number of days in inventory plus number of days in accounts receivable minus number of days in accounts payable. So in our example, Number of days in inventory was 20. Number of days in accounts receivable was 30. And number of days in accounts payable was 40. Which means in this example, our cash cycle was how many days? 10 days. That's the next point. Done writing? Now see the fun part here, assuming that you've finished writing. May I assume that? Let us say you are a big brand. Okay, so if you would observe the business model of Hindustan Unilever, the Indian wing of Unilever, let us say that their inventory processing time is 20 days. So day 0 to day 20 they spent on inventory. Then let's say they gave credit of 10 days. So total operating cycle of how much? 30 days. So on day 0, company received inventory from their suppliers. On day 30, they converted that to cash. But when they will negotiate with the accounts payable, that means those suppliers, they might negotiate a credit period of, let us say, 70 days. So technically what's happening is, you went to your supplier, you took inventory from him. Within 30 days you converted that inventory into cash. So ideally you should have made the payment to supplier on which day? 30th day. If you do that, you're simply playing on supplier's money. You're not investing your any money in working capital. In this case, what the company is doing is, it received cash within 30 days. For next 40 days, it used that cash free of cost. And on day 70, then the amount was paid to the supplier. So this 40 days, or in this case minus 40 days, is your cash cycle. And when your cash cycle is negative, that means the company is operating on negative working capital. It is not investing any of its own money in working capital. It is simply playing on supplier's money. Right? And it's considered as a really smart business strategy. And this is possible only for those companies who command a significant brand. For example, brands like HUL, where those third-party manufacturers are always willing to supply, because the supply is always large quantity, and the buyers are typically distributors. They are always willing to buy because the product is sold really fast. And if you have that capability to negotiate with both buyers and suppliers, then you can operate on these kind of business models. And of course 40 days of that cash to be used free of cost is a significant amount, because you can earn interest on that amount. Are we okay here?